And that's why I want to go into our next segment, wrap the week. So Fridays are a great one, in my opinion, because what we do is focus on the weekly close. We've locked it in. What does that mean? How has the long-term picture changed? What sort of tips can we pull out of that? And what I like to do is start with the Mindful Investor Live ChartList. This is the way that part of my weekly review process. If you've not used this before, it's easy to find. Click on articles, go to the Mindful Investor, which is sort of my homepage on StockCharts.com. And at the very top, you'll see a link for a live chart list, and that'll get you to this point. You're welcome to save the charts, send them to your friends, do whatever you like. So chart number one is the market trend, and it's worth noting here for the first time since last February, the medium-term trend that I follow, this is using the weekly PPO, just turned bullish on today's close. It triggered, it threatened to trigger earlier this week, but you really need to wait until the weekly close to lock in that buy signal. And just this week, it's finally turned positive. So you may ask, well, hold on a second, how has it been negative this whole time? Coming from the March lows to where we're at now, and I totally hear you. So the way that my market trend model has evolved is you've got 3 time periods. You have the long term, which for me is sort of a couple of years-ish. You've got the medium term, which is a couple months to a year probably, and then you've got the short term, which is a couple days to a couple weeks. And the idea is you look at the alignment of those 3 different timeframes, and based on what you're trying to do, that should, for me, it's not a system. It's not something I use, as a rules-based platform, but it is a something that runs in the background. I like using it as a way, as a lens with which to understand what I'm seeing around me. Just make sure that I understand where the trends have been headed from. So the severity of the sell-off certainly, shocked the model because, the downtrend happened so quickly, and usually it's a little more of a gradual turn, but did turn negative there in February. This is on that medium-term time frame. And then again, the uptrend, it was such a beatdown, and it took a long enough. There's enough of a time factor built on this weekly data to finally trigger it. So the short-term signal turned positive there at the end of March, which is sort of after that big first move out of the March lows. Now the medium term has turned positive. The only one remaining negative is the long-term trend, which is based on the 21 and 34 week exponential moving averages. And so it really wouldn't trigger until you get, again, it's sort of a continued follow through. I could see if the S&P gets above 3,000, the spiders get above 300, S&P gets above its 200-day and is able to hold that, I think you would see the long-term signals start to trigger fairly quickly, given the trend up until then. But worth noting, at this point, the short-term tactical trend, the medium-term trend, now positive. And again, that's not much of a surprise. And I still think we could go either way from here. And I think this will end up making a little bit of sense. It makes sense that this has been a significant run out of the lows. And now the question is, are we able to push through, invalidate the bear market rally thesis and return to previous highs? And so I think it's right about at that point where it makes sense that medium-term trend would swing positive for the model. As we mentioned with the daily chart, I think we covered this enough, but again, I think we're at that confluence of resistance. I think it's really key to see where we're at here. And it's not just on the S&P chart. If you look at, Cisco, you see it facing resistance, Apple, some of these bigger names, Microsoft, approaching what could end up being a huge double top pattern, or could be the breakout. Those stocks break materially above their early 2020 highs. I think you could be fairly optimistic about where we go from here. But again, my base case has been, we're at the later stages of a bear market rally. We correct a little bit. I think a break below 2,800, 2,750 is what really confirms that as the next leg. But for this point, we're sort of up in resistance and holding. Looking at breadth, I've color-coded these sort of neutral because you had a rally out of the lows on the cumulative advanced decline lines. This is looking at the daily breadth reading and accumulating those values over time. And so on the S&P, on mid caps, and then at the bottom on small caps, it's showing you where we're at relative to those. I noted a couple weeks ago, they all sort of broke down through a trend line, which to me was a potential signal that this was the next leg down. That's sort of, reversed, right? So you sort of now continue this pattern of lower highs and lower lows, but the market's not going down a ton. So I think reversing this pattern, higher highs, higher lows, would turn this more positive. When we get sort of a breakdown through the most recent lows, start to continue this pattern, this short-term downtrend pattern, I think I color code those red, and it suggests weakening breadth. But at this, it's sort of at a standstill of a little positive, a little negative. The new highs and new lows hasn't been much of a signal. I think that's characteristic of what happened up until today. If you look at the S&P, it's about 2/3 of the way back up retracing this move, and that's where the average stock, theoretically is. So you had a lot of stocks making new highs in February, a lot of stocks making new highs in March, or new lows in March, excuse me. You had a handful of new lows on these pullbacks. A lot of that was like energy and others, but since then it's been sort of a non-factor. And you had this signal last week where you started to have an increasing number of new lows, and this is as the market was going to the lower end of the range. But since then, this week kind of we popped up and we've sort of remained more at the upper end of things. So at this point, it's sort of a neutral, no real signal on either side of there. The breadth in the form of the 50 and 200-day moving averages has been really key. I think it's interesting to just take a step back and note that at the end of March, literally 0% of the S&P, none of the 500 stocks were above their 200-day or above their 50-day moving average, excuse me. Less than 5% were above their 200-day. From that moment of 0% above their 50-day moving average, we now have 4 of 5 above their 82% of the S&P has now recovered that level. So again, while not a signal of a long-term uptrend, certainly speaks to the reaction move out of the March low and how significant so many have come up. Also interesting to note that still 2/3 of the S&P below their 200-day moving average. So just like the S&P has not yet eclipsed it, most stocks haven't either. So until you see that, until that breaks above 50%, until you see a meaningful number of stocks getting above their 200-day, that long-term trend, I think it makes sense that it's still more on the negative side. The AAII rankings, just to finish on a couple more charts here for our weekly wrap session. Interesting to note, a lot more bulls this week. So as the S&P sort of closed above its most recent swing high, and certainly a higher high for the uptrend out of the March lows, you saw more bulls. Still not as many as we had after that initial push out of the low. So still a little weaker, but certainly a transition from more bears to more bulls. And so the spread between them is still 16%. So still plenty more on the bearish side than the bullish side. Then we have a series of ratio charts, and as you have time over the weekend or whenever you make time for a weekly review, I hope you can look through some of the charts like these, looking at things like within consumer. I've found that the cap-weighted version certainly indicates that consumer discretionary, the offensive side of consumer, has done better than the defensive side. The equal-weighted version has not nearly as high, but also starting to break out. So just at the end of the week here, breaking above the swing highs from April. So both on a cap-weighted, which is dominated by Home Depot and Amazon's the biggest weight in consumer discretionary. On the downside, it's equal-weighted, but still breaking out to new swing highs. So sort of confirming within consumer, there's been this continued rotation away from the defensive side of the ledger to the offensive side. A lot more charts in the live chart list here, and I hope you have time to go through it. If you have questions, just shoot them to us via email. We're happy to address them in a future show.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.